Hello, everybody, and welcome. This is my walkthrough of problem 5-3, balance sheet adjustment and preparation. So let's go ahead and take a look at what this is asking us to do. So we're given here a trial balance, and then it basically says LIFO is being used. Cost and fair value of long-term investments are the same. Amount of construction in process represents the cost expended on a date. Okay, so what we're going to do here is we're going to have Eastwood Company. Balance sheet as of 12/31/20. So we're going to start with our assets. So what we'll be starting with over here is we're going to have our current assets. So this will be cash. And our cash will be right over here at 41,000. Okay, we've got accounts receivable less the allowance for doubtful accounts is going to give us accounts receivable net. So our accounts receivable is 163,500. Our allowance for doubtful accounts is a credit, or basically how we show the accounts receivable net of that allowance for doubtful accounts. Then over here, we have inventory, 208,500. And then we're also going to be having here prepaid insurance. So our prepaid insurance is 5,900. So our total current assets is going to be the sum of these four values right here. Now, what's really important is that when we're going through in terms of putting in our assets, you're generally going to show them in the order of liquidity. Cash is obviously the most liquid, followed by accounts receivable, which we are showing net of the amount we're not expecting to collect. Our inventory is going to be a little bit less liquid than AR because we got to sell it. And then prepaid insurance is generally going to be like an other type of asset. So when it comes over here and it talks about that the LIFO inventory method is used, that would be something that we would be talking about in the footnotes to the financial statements. And let's just take a look over here and we'll see if we can find one over here. So we've got merchandise inventories for the Home Depot of 13.4 billion. And let's just take a look at this in terms of how this looks like on the financial statement footnotes. So let's go here. Let's see here, we got net sales. I'll just go ahead and let's find inventory. So I've got two facts. Let's see here. Okay, so inventory net. Okay, that doesn't really give us what we want. Let's instead try to do a find. Let's do inventory. Okay. So let's go to the next one. Inventory turnover ratio. What I'm really looking at is I'm really trying to figure out how the inventory works. So, okay. Okay, well, they should be disclosing how they're going through and doing their inventory method. So we might want to go through and look at that in the 10K, but the fact that the question here is mentioning LIFO, I would not put that on the actual the current part of the balance sheet itself. I would rather disclose that later. So now let's look at our non-current assets. Okay, and so we'll start over here with our property. Actually, we'll start in going liquidity. We'll have long-term investments. So with our long-term investments, we have equity investments that are long-term. And what it tells us about those equity investments long-term investments that consists of stocks with ownership less than 20% are the same. So over here, we'll just say equity investments. We'll say this is going to start out at being 339,000. And let's see what else it says. Okay, so right over here, this says the notes payable represents bank loans that are secured by long-term investments carried at $120,000. So this is saying that these equity investments are secured. So more than likely, if I would do something like possibly say C note B, right? If these are acting as security for this note payable, or if these are acting as security for a document, for basically, so the notes payable represent bank loans that are secured by long-term investments that are carried at 120,000. So I would probably just say like notes about talking about the securitization. So your answer to your textbook in the basically in the Wiley actually says 120,000 have been pledged to securities and notes payable at fair value. I would just basically put here equity investments at 339, but I would have to notate the fact that these are somehow pledged. The next one down here is going to be, we're going to go to property, plant, and equipment. So we'll start up here with, we'll have land of 85,000. We'll then have construction and process for the building of 124,000. We'll then have equipment is going to be 400,000 less accumulated depreciation. The accumulated depreciation is 240,000, which will give me equipment net of $160,000. So my total property, plant, and equipment is going to be 85 plus 124 plus 160, or 369. Let's move these out a little bit. Okay. So now I come down over here to my intangible assets. So for my intangible assets, I had a total over here of patents of 36,000. And over here, it tells us that the patents were purchased by the company at a cost of 40,000 are being amortized on a straight line basis. So you could do something like this. So the intangible assets net amount is at 36,000. And I do not see an account on here for accumulated amortization. So what this is telling me is that if the accumulated amortization is at 4,000, and why did I get this? It's because here it tells they were purchased by the company at a cost of 40,000. So that must mean if it's on my books at 36, they took 4,000 worth of amortization. So here we've got our intangible assets total here at 36,000. So my total non-current assets is going to be at intangibles plus the property, plant, and equipment plus the equity investments. So my total assets will be 1,154,200. Okay. Now going down the balance sheet in terms of my liabilities, I'm going to have current liabilities. So for my current liabilities, I'm going to be having over here, let's see what it tells me about my current liabilities. So I have accounts payable. This is going to be for 148,000. I'm going to have accrued liabilities of 49,200. And then lastly, I'm going to have my notes payable. And my notes payable are going to be a current liability because if they're due in 2021, that is within 1 year of this balance sheet date. And I'm saying secured because this again is being secured by those equity investments. Okay, so again, we would want to make some kind of notation. I don't think we would want to do the disclosure on the balance sheet itself. I would say you would probably want to go through and see the notes, again, depending upon the materiality. So that's our notes payable. So our total current liabilities. It's going to be the sum of these three numbers right here. Our non-current liabilities is going to be bonds payable. So my bonds payable has a face value here of 200,000. However, I have a discount on bonds payable. A discount on bonds payable is a contra liability account. And so this is going to show up as a negative amount. So my bonds payable net is going to be 180,000. So my total non-current liabilities is going to be 180. My total liabilities will be the 291,200 plus the 471,200. Okay. So now we get down to our owner's equity. Okay. For the owner's equity, we have common stock, and then we have additional paid-in capital, 45,000. Why these books continue to do this, I have no idea. And let's see here. So, the other thing too, we know that the bonds payable are going to be non-current because they bear interest at 8% and are due on January 1st, 2031. The interest has already been paid, so everything's going to be non-current. Okay, so over here, the discount on bonds payable, 2,000 will be amortized in 2021. That's pretty irrelevant. It just shows up still as non-current. So let's go down here to owner's equity. We're going to have common stock, par, 500,000. We're going to have additional paid-in capital, common stock of 45,000. We're going to have retained earnings of 138,000. So my total owner's equity is going to be the sum of these three values right here. And I just want to make sure I don't miss anything here, so that I've got total liabilities and owner's equity. Okay, so if we were really to be doing this in real life, what we would be trying to go through and do is, the way I would want to construct a balance sheet is I would want to find a company that's similar to mine, so I could basically look at the balance sheet. And when we're going through and talking about things like owner's equity, what we want to be doing is we want to be saying like, okay, common stock, what's the par value? How many shares are authorized? How many shares are issued? And how many shares are outstanding? So to really do this properly, kind of what your book is showing, is you would be saying over here, this common stock at par would really be, you would have, let's see here. So common stock, okay, $1 par value, 600,000 shares authorized, and 500,000 shares issued and outstanding. Okay, so all those things right over here, that's how I would kind of go through and kind of take a look at that. So I want to thank you for joining me here today, and I look forward to seeing you on the next video. Have a great one.